Good afternoon, everyone. I know it's been a long day for a lot of us, and we're just getting started. So we were supposed to hear a Senate bill, but I don't see Senator Huffstetler, so we will start with Carter Barrett. But before that, I'm going to ask Representative Yerda if he'd open us up in a word of prayer.
Thank you, Mr. Chairman. Let us pray. Dear Lord, we thank you for this day. We thank you for all our many blessings. We thank you for the opportunity to serve. Grant us wisdom and judgment on the decisions that affect people in the state of Georgia. In this name we pray. Amen.
Amen. Thank you, Representative Carter Barrett. This will be your first time getting the mic, and we are waiting anxiously with anticipation, knowing that you're a former bank CEO, and we can't wait for you to wow us with your knowledge. If you'll tell us about your bill, and go ahead, sir.
I'm speechless for the first time in 20 years. We've got friends from the Department of Banking and Finance behind me. We can talk to them about my banking experience, if you don't mind. But thank y'all, ladies and gentlemen, for having us here today, and for the privilege and honor of getting to present House Bill 531 to you. In the last week in the House, we actually voted on a bill. It was HB 285, which was for the public employees retirement plan, where we approved increasing alternative investments from 5% to 10%. And I just thought that was interesting, because this bill is not dissimilar in that this bill, HB 531, expands the list of eligible investment options for municipalities in the state of Georgia to mirror what is currently allowed by state law for the state and state agencies. It's a pretty straightforward bill. So for municipalities, not unlike a bank, you bring in money from your depositors. You've got all this money, and you've got to manage it safely and soundly to preserve your capital, to maintain liquidity, and if you can, generate a reasonable return as well. You have very limited basket of options that you can invest in. And if you're really smart, you hire really talented people to help ride shotgun with you to make really great investment decisions, as opposed to the CEO of the bank just sort of free-forming himself. So surround yourself by really talented people, and crafting this bill, that's exactly what has been done. There are a lot of talented people with a lot of experience in this space have leaned in to help form the language in this bill. The idea here is to take the somewhat limited basket of options for investments for municipalities and expand it a little bit, with an eye to safety and liquidity, soundness first, liquidity second, and then some return as well. The way the bill is structured now, though, it doesn't require any municipalities to do anything different. If they want to just continue doing what they're doing, they can do so. If they'd like to avail themselves of some of these other investment options, then they're certainly able to do that as well. But this bill prescribes that they should, if they're going to do that, they need to form a well-defined investment policy. They need to adhere to some continuing education requirements that are in this bill. They've got to adhere to certain reporting requirements in this bill. And then they'll have their auditors, review their actions annually and make sure that they're adhering with the policy they establish. So it's pretty straightforward. Take a limited basket of investments, expand it some safely, securely, sort of align municipalities more with the state of Georgia and how they invest, and put some continuing education requirements in there and a few other little things. But other than that, it's pretty straightforward.
Well, thank you. Members, do we have any questions from the committee? Let's see, 17.
Thank you, Mr. Chairman. Can we go through the bill?
Sure.
Thanks.
Representative Barrett, would you like to go through the bill a little bit?
Yeah, in fact, today we have quite a few experts who helped craft the bill, and I'd like to introduce Thomas Tite, who's Managing Director of Public Trust Advisors, and also Laura Glenn, who's also with Public Trust Advisors. And Laura, why don't you, if you would, take a minute and identify who you are and what your background is.
Sure. Hi, my name is Laura Glenn, and I served 24 years over at the Office of the State Treasurer, where we manage Georgia Fund One, the local government investment pool for the state of Georgia. During that time, I worked with several different treasurers, worked with a lot of local governments on not only what they were placing their funds with for us, but also on their own bank, what they were doing in their banking space or what they were doing investing on their own. So in that role really became kind of a public servant of making sure that folks were adhering to the policy, doing what was best based on market rates, and just really preservation principles. So the bill today, if we can kind of walk through it high level and come down, would be, we'll move that way. Sorry, getting excited. So high level coming down, the most important thing, like we said earlier, is that you're expanding the list of eligible investments. For a long time, the state code has allowed the state to do one thing and locals to do the other. So all you're doing is mirroring the state code, section 50 with, section 36 for the locals with section 50 of the state. So you're allowing them to participate in the same type of investments. Alongside of that, you're also, which has not been in there before, putting credit constraints, putting limitations around what they can do with those eligible investment types. So you're actually creating some guardrails around what's already established in the code for them. So, if you're thinking expansion, they're actually expanding, but actually narrowing the scope of what they can do as well, in some format. And I think the two other important things are you are requiring education. So most people who sit in a seat of a financial officer are not required to have any type of investment background. So you're not only saying if you're sitting in that seat, but if you want to do these expanded things, you're required to do 8 hours of continuing education in every year. That's a great thing. Anytime you're putting educated people behind public fund money, you are truly doing the first thing, which is preservation of principle for public funds. So really important goal for them. And then you're also requiring a written investment policy. If you go out to most local governments or cities, counties, they don't have a written investment policy in place. So it's kind of a, what are they investing in? What are they doing? You're also requiring them for their portfolio to put it out on the website. So as a taxpayer, for example, I live in DeKalb County, I could then go out to DeKalb County and say, where are you taking my taxpayer dollars? Where are you putting them? Where are they investing? So there's transparency, there's openness for the cities and counties of what they can invest in. And then the audit. Now, if you're saying that we are doing these things, that we're buying these new securities, you are adhering to, you are testifying to that you have a policy in place. You're reviewing it annually. You're getting 8 hours of continuing education. I know just from speaking at GGFOA conferences or giving webinars for them, that education is key. That, a lot of people don't even know that the Fed right now has probably been raising interest rates. Why are rates going up? So you're constantly, continually bringing them into the market and explaining all the various aspects of investing. So, as people retire, we have an aging labor force, right? You're bringing new people in. You're ensuring that anybody who steps into that role has the education that they should have to manage public funds.
Okay, thank you. Representative Hughley, 18.
Thank you, Mr. Chairman, and to the presenter of the bill and the author. First of all, is GMA, have they participated in this? And is this something that they are, the municipal association or the county associations, are they in line?
Yeah, in fact, we have representatives from ACCG and GMA here today. And if y'all are here, would you, Mr. Bowersox, would you consider speaking to the bill?
Yeah, just let us know if you're.
I just wanted, yes.
Yeah,
no.
yes or no is fine.
Okay. Yes, Representative Hughley, Ryan Bauer, so it's a GMA. We are in support of the legislation.
The other question that I had is when I look at this comparison that we've been presented, I guess this is from you. There are some things that have been left off that Georgia allows, but the proposed statute doesn't. Would you speak to those things that have been not included? Is that because of the risk associated with those, or what?
Absolutely. So originally in the bill, there were the use of derivatives, which I say that word and probably your eyes won't explode out of your head, right? What is that? So Exactly. What is it? And so we didn't really feel like that was appropriate for local governments. They're very hardly used, but sometimes when they've been used across the country, they haven't been used wisely, which has cost taxpayers money. And then the other thing we took out was a reverse repo where you can loan out your treasuries, get cash, and then use that cash to either buy more securities, which is called leverage, or you can just misuse the cash. So we felt like those things really shouldn't be at the local level. I mean, very few states use them. If they do, they use them in conjunction with debt. So that still remains in the code section with debt proceeds. So it's where it should be and not just for use just for fun.
Can I ask one final question, Mr.
Yes, ma'am. One more.
So because our counties they're so different,
Yep.
in terms of the size and sophistication of the staffing, are we confident that this one size fits all will take care of all of them?
This is actually, I would say it's not necessarily one size fits all. In other words, we've got with 159 counties and over 500 cities, you've got just an enormous range of ability, talent, experience, those things, sheer capacity to take on more, in the investment piece. I talked to the CFO of one of our larger counties. That's a pretty affluent county the other day. And I thought, as we talked through it, I thought, investments are very important, but this is a person who's doing an awful lot in any given day. And oh, by the way, the investment piece as well. And so the counties or the municipalities that want to just keep doing it like they're doing. I talked to a mayor recently. He said, oh, well, I've got so-and-so. He sort of keeps up with the budget. And then if we want to go try and get a yield on our investments, he'll kind of go shop CD rate or bank rates, excuse me. And then he'll come back and I just sort of make the decisions. So that would be sort of one end of the spectrum, right? The other end of the spectrum would be a very large county with very large surplus funds. And there's all shapes and sizes when you're talking about that many different municipalities. And this doesn't seek to completely tie the hands of a municipality. If they want to just keep doing what they're doing and have the more limited basket of investments that they currently enjoy, they can keep doing that. What this is designed to do is to create a little more flexibility, some other options. But along with that comes a little bit of responsibility. We kind of want to encourage our municipalities to get themselves well informed, to have a well-crafted investment policy. And if they're too small and they don't have the staff to create that themselves, then we would certainly hope that they would look out beyond themselves to bring that talent in, because there is wonderful talent out there that can sort of shepherd them through this process. So it doesn't take anything away, but it adds an awful lot.
Thank you. Thank you,
Thank
Mr. Chairman.
Thank you, ma'am. Representative Ridley.
Thank you. Are you talking about, when you say investments, are you talking about the retirement investments for the county or their actual, like
We're
take
talking
their cash, right?
It would be all operating.
Okay.
funds. Yeah.
All right. So currently the way it is now, and I know these two guys here next to me know, especially during 07 through 10, whenever our liquidity was questionable all the time in the banking business. With this product, the way you're doing it here now, like if a government puts money in the bank, you had to prop that money up with the matching capital, right? Which didn't work out real well when we didn't have capital. We had to come up with more. Is it the same way with this, or does it work different, or is it going through a company like Edward Jones, or is it giving them different avenues to go down? Is that right?
So I'll defer to them in a minute, but this bill speaks to every bit of that.
Okay.
It talks to custodial arrangements so that, when a municipality buys a treasury, they don't take possession of it and stick it in the drawer, right? There's
Right.
a third-party custodian. This bill speaks to all of those things. To your point about bank deposits, yeah, they are collateralized at 110% of the deposit amount, so that if I have a if I have a depository account in the bank has to secure that with or collateralize it with investments that they have, whether it's a treasury or a government agency security or whatever. But
Yeah, I would add that the investment market, has changed since the financial crisis. And so one of the biggest uses to both your points is that most municipalities put money in a bank and leave it there.
Right.
And the problem has been in the past 10 years is that the banks don't need the cash. They're flush with cash, but they want to take the deposit. And so they're holding on to it, but it's costing them because they have collateral that they have to post against the deposit. So this allows, this would have allowed them more options. For example, money funds are listed in here. That would allow a bank to sweep that deposit off but to hold on to the deposit, but to sweep it into a money fund, which would have been very beneficial. So for the smaller municipalities, that would allow them to maintain that banking relationship and still earn interest income on the dollars that are at the bank. So there are so many options in here for them. So even if they want to keep on doing what they're doing or consider new things, that they can do it and still do it in a very safe manner.
A municipality is it's a lot like a bank. First and foremost, the resources you have, preserving those resources first. So safety. Or Mr. Hagler back there would say safety, soundness, profitability, and growth.
Thank you.
Preserving capital first. Second would be liquidity. To make sure that you can fund whatever you have coming. So making sure that you're invested appropriately and your investment policy steers all of that and things are specified in this bill, steer all of that. And that's the whole point is liquidity was a big deal in the financial crisis during the Great Recession. This is designed to make sure that municipalities who avail themselves of these other investments, it creates additional liquidity, but it also creates a well-crafted financial policy sort of so that they are looking at those things. So
I agree.
I've heard some crazy things that people do to generate return. I think I kind of blanch and I think that's a little alarming. I'm certainly not going to use examples here. But
I agree. And I thank you for the bill. I think it's going to work out a whole lot better for our counties and cities. And once they get their head kind of wrapped around, just don't go stick it in your local CDs and that kind of stuff, especially when they're not been paying anything for years. And it costs the bank money. And but Mr. Chairman, at the proper time, I make a motion on this.
I got a few more Christmas trees lit up. So Representative Alexander, you've been patiently waiting and
Thank you, Mr. Chairman. I am a previous bank operator, so I definitely understand derivatives. I do think it would be helpful if you could go through each section of this bill.
Okay. You want to start? Now I got to put my glasses on. All right. So first defines what a local government is, right? Simply county, city, school system, board of ed, local authority. And then what kind of funds this is really addressing. So surplus funds. So anything that they don't need to meet day-to-day obligations of the county or city or board of ed. Doesn't, as it says in the second sentence under 36A3A1, does not apply to pension funds. They have a whole other section for pension funds. There's a whole other section of the code for bond proceeds. And then the next section I think is really important and upfront in this section. And it, for the first time, really lays out that you have to have an investment policy. And then it talks about the primary objectives of an investment policy. First and foremost, safety of capital. And then you have, flip the page, liquidity, right? And I do think that is one of the things I think this is going to do is you're for the first time going to get people to really pay attention to cash flow, whether they're sitting on too much cash or they don't have enough cash to meet obligations. You're going to have folks that have to pay attention to what's coming in the door and what's going out the door. And then getting next third is the yield or rate of return. And then 4, diversification, making sure, to put it in layman's terms, you don't have all your eggs in one basket. And then the investment policy, it goes on to talk about all the things that you should have in the investment policy. And one of the most important things is the prudent person rule, making sure that if you're sitting in that seat, you would do ethically what you should do with your own money. So really important change to the policy as well. And then it goes into, and I think it, does very clearly, lays out all the different things that should be an investment policy. So it kind of goes through the list of, again, numero uno is cash flow, cash flow, cash flow, cash flow. And so to your point earlier about, I was at the state of Georgia at 2007 during the financial crisis. Even the state had an issue with cash flow in that time. And we were trying to think of what can we do? We were selling investments out of the portfolio to fund cash. So, that was something we all didn't see coming, but we certainly can. And now even the rating agencies, as they rate debt issuance for municipalities, care about cash flow. They want to see what you have coming in the door, what's going out the door. And then also establishes, I'm going down real quick, puts parameters around what specific maturities you can do, issuers, instruments, what percentage you could put in any particular issue, how much you could have in commercial paper, how much you can have in corporate notes, how much you can have in mortgage-backed securities if you put them in the portfolio. And then also provides for a third-party custodian. If you're going to buy all these securities, you have to, you can't just go, as Carter said, you can't just go out and buy them. Someone has to hold them for you. They have to take the principal and interest payments in. They have to market them at the end of the month so that you have these beautiful reports for transparency to put out on your website. And then also kind of list who you're doing business with. Right. So you want to make sure it lays out here that you're not just have one person that you go to when you want to do a trade, that you're actually going out and competitively bidding, just like your county or city has to do for some of their other services, that they're having to go out and ask, hey, where would you offer the current treasury? And so they're getting 3 offers on that to see they're actually at the market rate of return or yield. And then, most importantly, again, internal controls, making sure that there is someone who is watching every step of this to make sure that you are truly protecting the principal. And, in this day and age, with everything going on with cyber and all that, this is important too, of internal controls, monitoring that cash. And then it defines who can act on behalf of that particular city or county. When I was at Georgia, the resolution for Georgia Fund 1 requires on there, a list of who you can do business with at the county or city. So I can't just take a phone call from Betty Sue. Like, I need to know who is authorized to act on behalf of the county or city. So you're doing the same thing in the investment policy. If you want to jump in.
No, I think you're doing beautifully. This is almost a paint by numbers guide on who's authorized to conduct business on behalf of the municipality, what they can invest in, the types of investments, the term, cash flow, liquidity, all those things. It's almost a paint by numbers. And I think our friends at PFM who also were very helpful in crafting this bill. I don't know if y'all might have anything to add to that, but please continue.
Okay, so and then we get to the list of eligible investments. So it just establishes what they can or cannot do. So this new list is if you come up with a written investment policy, these are the things that you can invest in. So the current local government investment pool, which is Georgia Fund 1, it allows for the first time, it allows for competing investment pools. So that gives them more than one option. In most other states, they have more than one investment pool option. So again, to someone else's point, now for someone who doesn't really want to manage the cash, they don't want to do all these things. If they come up with an investment policy, they can allow they could agree to this code section. They don't have to take everything that's in this code section. So the investment policy says, take the code and then decide what you like. So some small municipality might say, I only want to invest in number 1 and number 2. That's all they list on their investment policy. And that then puts guardrails around someone at that county or city. Those are the only things that you can buy. You can't buy anything else because that investment policy has to be approved. And then it also allows for mutual funds. Most of you probably know what a mutual fund is. You have money in them yourself. So allows for that. That's never been allowed in code. So they can only do a government only fund, which is a stable net asset value pool, which means you put $1 in, you earn a little bit of interest, you get your $1 back out plus your interest. So you're not really putting any principal at risk in those first 3 options at all.
Money market.
Money market mutual fund. What did I say?
You said mutual fund. Not-
Money market. Yeah. Money market mutual fund. Sorry. Yes, sir. Yeah. Page number, I will. Sure. And then U.S. Treasuries, which have always been allowed. U.S. federal government agencies, which have also always been allowed. So that would be like Fannie Mae, Freddie Mac, Home Loan Bank. We got that right. And then now we're going to introduce a new term, supranationals. And that's simply where 2 basically central banks come together and issue debt on the behalf of, and jump in here. They issue debt that benefits for countries around the world. So typically has a social benefit to it, but they are backed by the full faith and credit. So they also are AAA rated, but they're just more than one country coming together. 24 out of 50 states do that currently, allow for that. So if it's nothing that would be new across the country. It's just kind of joining folks who already have added that. And then bank deposits, municipalities have been doing that for a really long time. So this would allow, kind of sets out the parameters of how they can put on a bank deposit, making sure that it's collateralized by 110%. Who's holding the collateral? It addresses the issue of the bank pledging pool, so they can put the collateral in the pledging pool, which, taking my former days from a banker and treasury, they kind of became merged. That was an idea back in the early 90s. And now here it is, allowable way to post collateral, which is very beneficial to municipalities. So that's a good thing.
Nothing new there, though. right?
Nothing new. Yeah, I'm now on page 7. Thank you. And then we get to page 7 on number 8, non-negotiable CDs. So that's simply the CDs that you know about that you and I can do ourselves. We go, they would put money at the bank, and the bank's going to, again, post collateral versus that deposit. It also lines out negotiable CDs, which are just marketable securities that are sold in the market. So think about with a negotiable CD, you cannot, non-negotiable, sorry. You can't, if you want your money back, you put on a 5-year CD and you say, oh my gosh, I forgot that I have to build a building in 2 years. You go to the bank and say, I need to break that CD. They will give you the funds back, but there's an interest penalty for it. So a negotiable CD does not have that penalty. You can trade it in the market. I decide I don't want that anymore. I can sell it to state of Idaho. So you kind of can sell that security without taking a interest penalty. However, I would note there's no collateral behind that. So that's just a direct obligation of the bank that issued it. And then commercial paper that is allowed currently for the state, but not for municipalities. And we put parameters in there around that would be the highest credit rating, A1, P1 or higher. So you're making sure you're buying the note of a very sound financial company.
And that is something new, right? That's
Yes, that is new.
currently
So
not.
that is new. Still on page 7, obligations of this state or other states, that was already in the code. We just brought it in, but actually put, and this is where I would say, this is where we put guardrails around that and said, you can buy obligations of the state, but they have to be, the way we wrote it, if you flip to page 8, they had to be rated AA or higher. And so that puts that you're buying very sound state investments. If you didn't know, Georgia is only one of a few states that are actually rated AAA. So there's not a lot of AAAs out there. We should be proud of our state. And then obligations of domestic corporations is simply a corporate bond. That's, for example, like Apple goes out and issues debt, you could buy Apple. And again, taking it from A or higher. So putting parameters and guardrails around that. That would be new for local governments. Asset-backed securities, that would be new for local governments. And all that is you have a company like, let's say, Capital One. They have credit card receivables, right? You and I owe them money every month on a credit card. All they do is to get those assets off their book, they securitize them, and then an investor buys that. And the principal and interest payments that come through every month, maybe a car loan, right? Those get distributed straight through to an investor. And so when you make those monthly payments, they come into a little house and then they go back out to the investors. Very safe. Most of those are rated AAA because they have a ton of collateral behind them, way more than the debt that they issue. So very, very sound investment. I don't think they've ever had one default on those. So, and then agency mortgage-backed securities. So that is simply you and I have a home loan, right? And so the banks sell those mortgages off their books so that they can have get more capital back, make additional loans. So they securitize those and then they sell those to investors as well. So every time you and I make our principal payment, our mortgage payment every month, the investor gets part of that principal and interest payment. Good. Okay.
Nothing new, nothing-
So so that was new as well for local governments. Number 13 was new. So staying on page 8. So this is what Carter was saying earlier. If you choose not to have a written investment policy, then you can do business as usual. So from page 8 through page 9 is basically what you can do if you don't have an investment policy. The only thing that is new in there are the number 2 and number 3, which is letting them have an additional investment pool choice and also allowing for mutual funds. The rest of that is as is. Money market funds. Sorry, I keep saying mutual funds. Money market funds.
point of clarity, this basically fallback position would be just the safest, most liquid investments. Is that correct?
Yes, I mean,
When,
Yeah.
Yes.
no, yeah, so anyhow, I just wanted to add, I don't quite understand why that's in there. It seems to me you would mandate an investment policy.
policy.
And if
know.
I could interject, just a quick question. First of all, this is completely voluntary. No, it's no mandate. Any local government can choose to participate in this or not, correct?
Correct.
And then number two, when they set their investment policy, these are the choices the listed investments, approved investments. They don't have to choose every one of these. For example, for some reason, they don't want to take the supernaturals opportunity to invest in those investment mechanism. They don't have to, correct? They can state what they want that best suits their risk profile and appetite and cash flow needs. And is that not correct?
That is correct.
Okay, I just want to make sure I have clarity on that. Thank you.
So
Thank
you
you.
think about the code gives you a big world to choose from. And then your policy is narrowing that choice down based on most people, what their risk tolerance is, right?
That's
Yeah.
the way I just want to be sure I was reading it correctly. Thank you.
Yep.
Thank you, Representative 23.
Yes, thank you, Mr. Chairman. Just one quick question on line 134 on page 6, or maybe 135. Are all these investments, would they be rolled up under the market to market daily accounting practices?
So CDs.
Yes.
All the other ones, you could
Yes.
choose, you could
Okay.
ask your custodian to market daily. Most municipalities around the country do it at least monthly. But mutual fund, money market fund, by the end of this, I'm gonna say money market fund, the local government investment pool does it once a month currently right now, or at least once a week if they're a rated fund. In the case of, I think both PFM and PTA, we both all mark our portfolios to market daily. And then a mutual fund would be marked to market daily as well.
Okay.
Some of the other investments in here would at least be marked to market every month.
Monthly?
Yeah.
Okay.
Thank you. 24.
Thank you, Chairman. Thank you, Representative, for bringing the bill. Couple things. One, I just want to hit the high notes for me to make sure I'm clear on what the overall objective is. This is going to put our cities and counties in a better posture so that they're maximizing earnings at a managed and known risk, or at least relatively known risk. Number two, it's going to put us in a position that if we do face another unexpected financial crisis, come what may, that they're going to be better postured so that they're going to know exactly where their liquidity situation is. They're going to have a defined, process and a plan, I guess, if you will. I know lots of times staff within cities can change frequently. There are elections that can change dynamics. So there's always kind of this underpinning of new, we got a lot of new folks in this building now, same kind of situation. That way everybody's going to sing from the same songbook as they approach this. And the last thing is, the reason that the derivatives piece is not included in this, it's not necessarily because it's complicated. It's because individual cities would be taking on more risk than is probably worth that potential incremental yield opportunity. Is that the reason that was kept out?
Yeah, derivatives are by their very nature tend to be very complicated, and a lot of my friends in the banking industry have in years past had to provide interest rate swaps and things for clients to help go from floating to fixed rates, or fixed rates to floating rates and things like that. And they were frequently selling things, and you had a sense that they really didn't understand them very well.
Okay.
And these are experienced, trained people who had a hard time with derivatives. So it's one of those things that it really doesn't add a lot, and why bother? Why
Yeah.
go there?
I mean, I agree with the policy. I just want to make sure it's not necessarily just because it's complicated. It has to do with risk profile and making sure that we're not allowing cities to take on undue risk. All right. Thank you very much. And I too, at the point where I'm ready to make a motion as well. Thank you.
27.
Thank you, Mr. Chairman. Appreciate you bringing this, Representative Barrett. Sounds like a good bill, being a former elected official, local elected official. That does give options to the cities and the counties, and we appreciate that.
Thank you. Two more, Representatives, is that 17 or 14?
17.
17,
Thank you.
17, please.
Thank you,
Gloria,
Mr.
Fraser,
Yeah.
please.
Thank you, Mr. Chairman. Is this legislation specifically for banking institutions and for local municipalities? I know we're talking about the banking investment securities, but where is my federal credit unions as it relates to this? Is it just for banking, local banking for municipalities?
So typically a credit union would not, they're not going to offer these type of securities. They don't offer safekeeping services. Those are usually like a SunTrust, Truist, for
Right.
safekeeping. This is really kind of not a space they play in, and that's why they're not referenced here.
Thank you.
Thank you. And then 14, please.
Thank you, Mr. Chairman. Some of the smaller municipalities do not have websites. How would the report become available to them?
I would assume that would be by mail, wouldn't it? Or email?
Yeah, they don't, I mean, I guess you could define what public dissemination is. I mean, if you have a board meeting, you could say that was public dissemination of the information. That's how a lot of them do it, that they have, so if you are an interested party in a small county, you have to go, that's how a lot of them do it when they're smaller, that they go and they discuss the investment holdings at a quarterly meeting. And so if you really want to know about it, you can, and it would typically be in the minutes or the meeting, agenda that they were discussing that. So that I understand that. But you can figure out what that means, what public dissemination means.
Okay, thank you. Follow-up question, Mr. Chairman?
Ma'am, you good?
Follow-up.
Yes, ma'am.
In terms of the investment policies, what do you recommend the frequency for renewal of the policy?
You see anywhere,
Please speak to the microphone.
Different states have different requirements. Some require an annual renewal of the investment policy. Some require every couple years. Not many things change in this world to necessarily force a change every year. But it could be a good practice to at least evaluate the investment policy on an annual basis, not necessarily need to make changes. Would be a good policy.
And we have 2 people here.
One thing I would add is annual, and if you have new personnel or a new treasurer or a new head, you should then go over that with them when they come into office.
Who are the 2 people?
But you might want to speak to the reporting component, though.
We had 2 people signed up to speak. Ryan Bowerson.
Bauer Sox.
Okay, Ryan. Sorry about that. I butchered your last name.
Mr. Chairman, members of the committee, my name is Ryan Bowersox with the Georgia Municipal Association. GMA is in support of HB 531. We thank Representative Barrett for his work on this bill. I don't want to reiterate a lot of the good conversation you've had because I think the highlights have been hit at this point. But do just want to say HB 531 is not going to impact all of Georgia's 537 cities. A lot are going to be able to continue to invest in the manner they are currently. But those who want to utilize the provisions of this bill within the safeguards, adopting the policy, utilizing these new investment policies, the safeguards put in place, we see a lot of benefits for the cities, diversifying in portfolios and higher rates on return. A lot of this good discussion has been had. So just want to express GMA's support of the bill, urge your favorable consideration, and I will take any questions the committee may have.
Thank you. I don't see any questions. We had one other person signed up, Sean Gannon. Let us know who you're with, please.
Sure. Good afternoon. My name is Sean Gannon. I'm with PFM Asset Management. We helped author the bill with Representative Barrett. And we want to let you know that we support as well everything that's in here and are open for any questions as well.
Okay. 25.
So, yes, so thank you. I just want to point out that we've worked closely with former Representative Edward Lindsay, who's done a great job of representing y'all, and give you full credit for having brought this measure before the House of Representatives almost a year ago. So thank you for your efforts and work on this important measure for Georgia's local governments. Thank you.
Thank you, sir. 22.
Mr. Chairman, in light of time, since we got a hard stop at 4:30, I'd go ahead and make a motion for this bill do pass.
We have a motion. We have a second. Any more discussion? All those in favor say aye. All opposed? Thank you. You got your bill. You need to get it to rules as soon as you can. And the next hearing we're having is Chairman Bonner. This is a hearing only, and Chairman Bonner and I have been working together on this and look forward to hearing your presentation, Chairman.
All right. Thank you, Mr. Chairman. Members of the committee, I appreciate the opportunity to present House Bill 342. I have with me here at the table Deputy Commissioner for Legal Affairs, Bo Fears. He is here not to speak yay or nay on the bill, but simply as a subject matter expert on what it would look like provided we are able to make this move up under Department of Banking and Finance. So, and then I will also apologize up front for the length of the bill, but the vast majority of that is essentially what it looks like if we do move this industry up under Department of Banking and Finance.
Let me interrupt one time. I did hear Chairman Smith say something about 7 to 8 pages, and this one's 45 pages. Am I not correct?
We may break it up into chunks just in case, but
All right.
but absolutely, point taken. So we have styled this bill as the Motor Vehicle Title Loan Act, and just so we're all kind of on the same page, this and I'll just give a very simple explanation of the industry. They establish collateral by holding title to a vehicle, then they loan money against that collateral at an interest rate for a period of time. Essentially, they are a lender. However, they are currently regulated as a pawnbroker. They are regulated to some degree at the federal level by the Consumer Financial Protection Bureau, and to some degree at the local level by the counties and cities in which they operate. But there's no state level oversight of this industry, which often operates in economically depressed communities and can trap individuals in a cycle of debt that can last for years. In fact, the Department of Defense reviewed this industry, and as they often prey on members of the armed forces, and they set some very strict limits through the Federal Military Lending Act that passed a few years ago. Now, House Bill 342 doesn't create any new law. It simply makes the existing industry of title pawn subject to existing laws. The bill seeks to accomplish the three things. First, it moves the oversight of the industry to the Department of Banking and Finance, the same as all other consumer lending products. And again, that accounts for the bulk of the bill. Second, it requires a surplus of funds, proceeds back to the consumer if someone's car is repossessed. And then third, it subjects title pawns to the same usury cap that literally every other Georgia lender is subject to. Title pawn lenders are currently not subject to Georgia's usury statute. They typically are collateralized at more than double what they lend to their customers, and the interest rates charged can average as much as 187% and go as high as 300%. So we've identified that there is certainly a need to provide some level of state oversight to this industry. You should have in your packet some different information, whether it's letters of support for this or press releases on some recent consent orders that came out last week on folks that operate in this industry. So we have seen that there is a need to protect the Georgia consumer, and we believe that this bill does that. Now, in deference to time, Mr. Chairman, we'll certainly be available. I can walk through page by page, line by line. That was essentially the overview, and I know there's some folks that can speak to the bill for and against, so I'll be available for any questions that you have, Mr. Chairman.
Thank you. My phone's already lighting up. Representative Hughley.
Thank you, Mr. Chairman. To Representative Bonner, first, let me thank you for bringing the bill, because it is an issue for particularly for people in lower income areas. I particularly like the surplus back to the person who's making the loan. But if I recall, they roll these loans over time and time again. Does your bill speak to that?
So the way it addresses that, and these are, as I understand, meant to be short-term loans, that they can often turn into a much longer term. The way that it's addressed in the bill is in that usury language. So whereas right now they're not subject to that usury cap, what it does is make them subject to the statute, which that usury cap is 60% on an annual basis.
But if I remember correctly, they would never get to the end of the term. They would just rewrite it. And then it would just go on and on and on. So I'm saying, are we addressing that part of it?
So the bill itself does not address the length of time that folks are able to enter into or pay off these loans. What it does to help mitigate some of that is does establish make them subject to the usury. There's also a lot of disclosure information or requirements in the bill as a part of coming up under the Department of Banking and Finance. Everything from verbiage to say, this is what the loan is going to cost you at the end of the day, to, some very specific language as to what it is that you're paying, both in fees, percentages, principal interest, that kind of thing. So those are the things that kind of mitigate, I think, what you're getting at, but there's nothing in the bill itself that stipulates the length of time that they can enter into these agreements.
Thank you. Thank you, Mr. Chairman.
Thank you, ma'am. Representative Ridley, 22.
Oh, trying to speak at the same time. Okay. Me and you had to talk on this bill and I didn't know what I was really signing until after I figured out after I read into this thing. So I guess I have a poor and impoverished community because I have one of these, but this a title pond is different than a loan. Like in the banking business, when you do a loan on a vehicle, you loan 80% of the vehicle, it's set up on 5 years. Here's your APR, all that stuff. And the bank's always going to be in a better position. These places, what happens, the reason they're charging so much is because when a bank goes by NADA book on what they're going to loan out on your vehicle, and they're only loaning 80% of that, they're taking everything into consideration, mileage and all that stuff. These guys are loaning out money on a short-term deal, and half the time the cars ain't worth what they're, I know you said they're loaning like 50% or whatever, but the cars really ain't worth 50% of what they are. And the people are still driving the cars while they're loaning on them. And my problem is we had this a few years ago. I can't remember if you were here when we had this kind of issue with this kind of same deal. The problem I get into is how do you legislate morality? I see people poor all the time in my community that lives in a little old trailer that probably needs to be hauled off, but they're carrying around a $1,500 cell phone, or they're carrying $800 tennis shoes. So I don't know I don't know that on a legislative level, how we would ever, I don't know, we could pass enough laws for to fix any of that.
Well, I would agree with you. We can't legislate behavior per se, but I do think that we can put everybody on a level playing field. We can provide oversight to at least protect those individuals from at a consumer level, right? You can't, you certainly can't, regulate what folks will and won't do given, their financial situation, but we can, I think, establish some guardrails that protect them at the consumer level.
And how do you do that? Like in terms of, we had a ticket bill yesterday that nobody reads the terms and use on a ticket, and they're griping about that part of it. But if the people don't read it, they don't understand what they're signing, because even if they did read it, they don't understand some of the stuff.
Yeah, there's no doubt that there's some things you simply can't address. I would submit that bringing the industry up under the Department of Banking and Finance adds that layer of protection, not only for the consumer, but I think it does add an extra measure for the industry to make sure that they're adhering to good business practices.
Okay, and Mr. Chairman, one more thing for
one more.
my friend over here at the banking deal. How in the world would y'all be even capable of regulating this industry? I don't think they're going to be able to hire auditors and have samples ready for y'all to come in and pull loan documents on. So how would that even work?
Yeah, so the department, we currently regulate a number of non-depositories, as you're well aware, right? Every year we come before and we present our housekeeping bill. So we currently, we regulate mortgage brokers and lenders, installment lenders, small dollar lenders, money transmitters. So we have some background. I think that's why, if you look at the first half of the bill, That's why a lot of the provisions are really identical to what we do in the other spaces, right? So we can get alignment. We do have limited resources. There's no doubt about that. But if we have that alignment, it would help, it helps us. And that's really our involvement in bills, right? When it's not a department bill, but it's a bill brought by someone else in the non-depository space, we work with them to try to get that alignment so that we can try to carry out the will of the General Assembly in the event the legislation is passed. This bill also, though, at the very end, it indicates that it's contingent upon appropriations, right? There was a fiscal note that was prepared a few years ago by the auditor's office. And I apologize, I can't remember the exact numbers, but essentially it indicated we would need an annual appropriation of roughly $250,000 in addition to a one-time appropriation of $120,000. Because you're correct, even though we do have that alignment, we do have limited resources, so that in order to regulate this industry, according to the auditor's office, we would need appropriation of roughly $250,000.
Okay, thank you.
27, please.
Thank you, Mr. Chairman. Thank you, Chairman Bonner, for bringing this bill forward. Any idea how many states currently regulate this industry?
I believe there's 29 states that provide some level of regulation. And that ranges everything from outright banning this type of activity to regulating it to some degree.
Okay, thank you, sir.
Thank you. Number 24.
Thank you, Chairman. Thank you, Representative Chairman, for bringing the bill. You answered one of the questions about the expectation on how many folks you would need to manage this process. I've listened to folks that are passionate on this issue on both sides, and I have, I don't care to tell the people I've told I'm conflicted because, you know, I understand. I laugh often as a banker where we have, if you're a high performing bank, you have a 4% margin given the regulatory environment that we're in, and it's not easy to have a 4% margin in the environment that we've been in, honestly, the last 2 decades. So I'm sympathetic to having some type of a justification for this type of lending to have such an opportunity to yield such a return on their investment. I do acknowledge that how you determine the value of one of these assets that they're loaning on is oftentimes very difficult because they are not, I mean, it's what you would consider C credit. My question is 2 things. One, if a holding company or a S corp bank were to purchase as a separate line of business a title lending company, is that something that would automatically bring that line of business under the department because of a financial institution? Not advocating for or against that idea. We're in a world where credit unions are buying a lot of banks. That creates changes, issues, questions. And so I'm curious about that. And number 2, do the companies that provide title, loans, do they report to the big 3 credit agencies? Do you know?
I do not know that. On the first question, that would be a question for Bo.
You want to try the second one first?
Well, the second one, I don't know.
Okay.
We've got folks here from the industry. We can certainly ask them.
As to the first question, there's not an exemption for holding companies. So it would capture a holding company. They would require to have a license if this was passed.
Okay, no, that's fine. Just want to make sure. And I'm assuming that banks are probably prohibited because then all of a sudden that line of business would fall under the usury law automatically if they were to purchase one of those type companies.
That would be correct.
Okay, thank you.
25.
Thank you, Mr. Chairman. So, Bo, let me ask you a quick question. Could you guesstimate between the application for a loan on a car, somebody walks in the bank, how long does it typically take to go through the loan process, the application and the credit approval and the issuance of a check in a bank?
I have no idea, Representative Williamson. Representative Wade will probably have a better answer than I would
Do you mind
guess that.
answering
Yeah.
Usually between 24 and 48 hours, if it's not complicated, they can take up to 3 days, depending on if there's other issues that arise, but it can take generally a day to 3 days.
And when you have a willing lender and a willing buyer, and I mean, a willing lender and a willing borrower in a situation like this, how long does it take them to get cash in a title pawn operation?
Again, there are folks in the industry here that can address that. I would assume that if you walked in with a valid title, you would be able to walk out with cash.
And then just to follow up, in my mind, it is a pawn, unlike a lawnmower, they can let the person drive the vehicle after they've lent them the money because they do have collateral. They've got the title to hold. But if it's a regular pawn store and they take a lawnmower in there or whatever, they're nail drivers or whatever, not only is a nail driver sitting there they can't use to go work with to frame a house, well, that's the biggest problem. They can't use it, but the whomever is making the pawn on that has to hold it because they don't have a title to they can go find that nail driver off the job site, if I'm making sense. So there is in my opinion, is it not true? There's an advantage for people that really need that $500. They don't care if it costs them more than a good bit of money, if it allows them to make it fulfill an immediate cash obligation need that might end up costing them a lot more over time. I just want to make sure that we understand the value that immediate access to cash has to a lot of people that are underbanked.
Yeah, so your point is definitely well taken. The bill itself does not inhibit one bit that transaction taking place. So operating under this bill, the customer can come in and complete that exact same process that they're completing today. So their access to that cash is not impacted.
Thank you. 29.
Thank you, Mr. Chairman. Mr. Fears, in your estimation, if we were to regulate this, how many of these companies are operating in Georgia do you estimate?
And I do not know the answer to that. The Department of Audits, they've looked at that number and it's in that fiscal note that they prepared a few years ago. I apologize. I don't have access to that right now. There was an estimate that they looked at two different data points and they came up with a raw number. And I can pull that up from a couple of years ago and provide it to you later. But that's how they came up with the estimate.
Yeah.
That we would need up to three full-time employees to regulate it. The industry.
Thank you. We had a few people that were signed up to speak to the bill. We'll start off with Andy Lord from Georgia Watch. Andy, and I'm going to give everybody 3 minutes if you can do it in 3 minutes.
The committee, thank you. My name is Andy Lord. Pardon me, I have a little bit of a sore throat. I represent Georgia Watch, consumer advocacy organization here in Georgia. We stand in support of the legislation and thank Chairman Bonner for bringing this legislation. As he indicated, it's important to note that this bill really does nothing to extend law in Georgia. All we are doing is making an existing entity in Georgia subject to existing law in Georgia. There is no new law going in place over here. There is one lending entity in Georgia operating outside of the usury statute, one, and it's Title Pawn. We are simply trying to put them on a level playing field with every other entity. As the chairman indicated, we're also concerned about refund of surplus. In this scenario, if you were to borrow $4,000 on a $10,000 car, to use a round number, and you paid back $3,000 of that and defaulted, they can repo your car, sell it for 10, keep the full 10. We think that's wrong. We think the difference should go back to the customer. And of course, we think they should be under the agency. Some of the very good questions that are being asked today, we're having to ask precisely because they're not regulated. We don't know how many of these title loans were issued last year. We don't know how many went to term. We don't know how many were repoed. We don't even know what we don't know in the state because no one oversees this body. The chairman also mentioned that the military banned all lending over 36%, including Title Pawn, because of the detrimental impact it was having on our troops. That included security clearances for senior officers. It included low-income troops that were getting buried in a cycle of debt. So the military said no more. Now, our opponents argue that nobody else will lend to these people. They're the only people to do it. Here's what we'll say to that. There are 30 states that don't even allow this lending. And there's no evidence in those states that there's lack of an access to capital. And let me tell you what else the military didn't ask when they banned this lending. They didn't ask, where are our troops going to go? They just said, wherever it is, it's better than this. So the military, as the chairman indicated, has banned it. You also have it in your packets, something that just happened Friday. Literally this Friday, it looks like this. The Consumer Financial Protection Bureau fined Title Max $10 million. There was an additional $5 million in restitution to customers that they overcharged and charged illegal fees to. In this situation, according to the CFPB, there were 2,600, they say at least 2,600 prohibited loans to our service members, illegal loans to our service members. But they also found that in 15,000 additional loans that they overcharged and charged illegal fees to customers. This is one of many title entities in Georgia. So we have 18,000 cases of illegal lending. And notably, this is the second time that the CFPB has fined Title Max. The first time was for 9 million. The second time is for 15 million. And last comment, Mr. Chairman, I've been asked by a couple of members of this committee fairly. Well, this is the CFPB. What happens if the CFPB goes away? I think it's a great question. There's now a case that's going to go to the Supreme Court to determine the validity of the CFPB. Here's what I would say to the committee. If the CFPB goes away, we need this committee's help even more. They are the only entity overseeing this entity. So my contention is if the CFPB goes away, this committee's work becomes more important, not less important. And nothing in this, we just found out about this lawsuit Friday, or this fine on Friday. This bill predates this fine. This bill is important because they charge up to 300%, because there's no refund of surplus, and because they're entirely unregulated, while everybody they compete against are regulated. So without regard to the CFPB, this bill, we believe, remains critically important for Georgia. And thank you again, Chairman Bonner, for bringing it. And to you, Mr. Chairman, I know I'd be the path to your door. I
That's fine.
appreciated
That's
your
fine.
time.
Hey, one more. I got one question for you. 24.
Thank you. Appreciate it, Chairman. So you touched on the CFPB and its constitutionality. So for the record, I don't believe that the CFPB is constitutionally funded currently. And I believe that I understand there was concerns with consumer finance, but the prudential regulators, every single one of them had consumer protection departments within themselves. Even the department here has a watchful eye over consumer protection. And I trust our department more than I do the CFPB, and I don't care if they like it or not. My other question is in the 29 states in which this exists, to the bill's author, and if you have someone here that can answer this, do you know if those industries have made changes to comply with the 36% lending cap for the interest rate for the DoD borrower? I mean, if they're in business and that's a subset and they're wanting to serve, I believe all companies in our country, the vast majority, want to be helpful to our members of the military and those families. So I would assume that many of those businesses have adjusted their practices and don't intend to break the law. Do you know anything about the other states?
Well, here's what I'd say, that there are some states where at least one company is pulled out of and doesn't do business. In terms of how different companies deal with the military, with the one that I did speak with directly, they outlined for me what I thought was a very reasonable process on their end for, making sure that they don't lend to the military at that rate. As we saw during this last consent order, sometimes those procedures don't capture everything. But I do think that, in general, these companies, are certainly, they don't want to be fined as like anybody, nobody does. And so, I think that they certainly have tried to put some practices in place in order to mitigate that. But obviously, I mean, again, to me, that kind of speaks to the need for further oversight.
Thank you. Thank you, Mr. Lord. Next speaker is Travis Bussey.
Mr. Chairman, we got that Zoom thing up for my chief legal officer.
Oh, yeah.
Okay, cool, man. Good afternoon, Mr. Chairman and members of the committee. I'm Travis Bussey, the Vice President of Government Relations for TMX Finance Family and Companies. We currently offer consumer credit products in 15 states under Title Max, Title Bucks, and Instaloan brands. In Georgia, we offer motor vehicle title pawn transactions under the Georgia Pawnbroker Statute. Thank you for allowing us to appear before you today to discuss our opposition to House Bill 342. Title Max is a Georgia-based company that has been in operation in the state since 1998. We currently have 482 employees and 207 Title Max and Title Bucks locations across the state of Georgia, plus 133 employees in our Savannah corporate headquarters. First off, I'd like to touch briefly and address the CFPB settlement that was announced last week. Despite having significant legal theories and the Bureau being shrouded in a cloud of unconstitutionality, our company decided to settle with the CFPB instead of pursuing costly and protracted litigation. Title Max instead chose to focus on our core value of offering best-in-class customer service and offering credit to the underserved. In its review of company offerings back to 2011, the Bureau alleged two discrete issues that were mentioned, military lending and non-file insurance practices. The company has never intended to loan to covered borrowers under the Military Lending Act and had robust policies and procedures in place to prohibit lending to covered borrowers. The agreement with the Bureau indicates the company's effort to further tighten those policies and procedures and processes. As to the non-file insurance, which was a product that we only offered in Florida, the company discontinued that product offering in June of 2021. So if nothing else, the agreement with the Bureau shows that Title Max works with its regulators to address concerns and implement additional practices to further support compliance on all fronts. Now, moving on to HB 342, we are not opposed to reform to enhance regulation at the state level that will continue to allow industry to offer small dollar emergency credit products to Georgia consumers who are underserved by banks, credit unions, and traditional retail installment lenders. We also remain open to discussions and commit to work with Representative Bonner moving forward towards meaningful reform that preserves needed access to credit in Georgia. However, we have major concerns with the language in the bill. So I'm gonna turn it over now to our Chief Legal Officer, Victoria Newman, who's joining us remotely to address those concerns with the bill.
Hey, Travis, can you hear me?
Yep.
All right, perfect. As Travis mentioned, we significantly appreciate the opportunity to talk about the bill, especially, and I appreciate the ability to appear remotely. I'm actually on maternity leave, so Travis and I have been coordinating accordingly. So I would identify the issues with this bill into a couple different categories. Most importantly is that there is no effective date for the proposed bill, and it requires a significant amount of changes for existing pawnbrokers in the state that we would need to implement to comply. There's an existing licensing structure that is outlined in the bill, and every existing pawnbroker would have to apply for, wait to receive a license before continuing operations, as the bill says that to offer a title loan without a license is a felony. However, there is no discussion in the bill about how existing pawnbrokers would be able to apply for those licenses and continue operations as it did so. In addition, under the CFPB's purview. It regulates any UDAP violations, and that's unfair, deceptive, or abusive acts or practices. Currently, as a pawnbroker, we have to advertise according to the Georgia statute that we are a pawn and not a loan. Every existing piece of signage, every storefront that we have lists the product that we offer as a pawn. In order to come into compliance under this particular bill, we would have to change all that existing signage, the stores. We would have to change all of our advertising. That is a significant undertaking. As Travis mentioned, we have 207 locations. Additionally, the biggest thing for us is there's an existing set of rules and regulations, and the bill constantly refers to the department creating these rules and regulations. However, we haven't seen what those rules and regulations require, and we can't understand what we're actually agreeing to until we see it. So in addition, moving on, I'm trying to make this very quick to fit within 3 minutes. The definitions of the bill are problematic. The definition of owner, the definition of misrepresentation, executive offer, covered employee. There's a significant discussion about using NMLS and how when we sign up for NMLS, the department then could use anything that we provide in that and share it with other regulators. There's additional licensing requirements that would need to happen for every branch location, including the original corporate location. There's discussions about investigations and fees for investigations, fees for examinations. However, those are not defined. There's discussions about advertising and how we'd have to change our advertising requirements and create unique identifiers for every piece of advertising included, but we don't know what the unique identifier is. There's additional criminal history and employer requirements that we would have to implement, where we would have to run criminal histories on any director, executive officer, covered employee. And we couldn't sell to anyone else unless they had the approval of the department. We also couldn't operate under an existing name unless the department approved. And not to mention that this creates a rate cap that does not exist under the current pawnbroker statute of 5% per month. And as this discussion has outlined, we loan to a borrower that is significantly more risky than a bank would loan to. And accordingly, the rates that we charge are going to be higher. And so one of the things in saying that this new law is going to level the playing field, no, it would not, because it would actually regulate us out of business, because we could not offer these pawns to consumers at the rate cap that is considered in this bill. I have significantly more detailed notes about this. However, I respect the team's.
Thank you. We do have a few questions, so
Sure.
I don't know if it'll be directed toward Travis or yourself, but thank you for joining us. Representative Hughley, 18.
Thank you, Mr. Chairman. Going back to a question that was asked earlier, I walk into Title Max with my title. Explain to us how that process works.
All right, so you come into the store, fill out the application, walk through the application. The first question asks, are you covered borrower? Then they go outside with an app, take a picture of the car and make sure the car is running. Then they come back in, and then we do internal underwriting process, and they could have, their check within probably 45 minutes. So the whole process lasts about 45 minutes.
What are you looking for in your underwriting?
Victoria?
Sure. So we underwrite the customer as well as we underwrite the collateral. So we run a clarity report of the individual borrower, and we assess based on that clarity report, what are we willing to loan to that customer. We also look at the collateral. To Travis's point, we take pictures of the collateral, we rate it, and we use a combination of those two scores to determine what we're going to provide to that customer. We give the customer the opportunity to review that number and assess whether that is something that they would like to undertake or not.
And when, if I can ask.
Yes, ma'am.
Okay, and when you disclose to the customer what this means, how is it explained?
Yes.
To the customer?
So it's similar to any other consumer lending product. There is a TILA box, truth in lending box in the loan agreement, and our employees are trained significantly to walk the customer through the Truth in Lending Act disclosures on the first page of the agreement, which are prominent and in a bold font on the first page. It explains that the pawn is for 30 days and that our expectation is three things. One, this is a 30-day product. Our expectation is that you pay the amount in full by the 30-day period. If that is not something that you can do, then there are two other options. You could pay and you could refinance the product and extend it for another 30 days and pay the minimum amount due. However, that is not what we suggest. We suggest that you pay somewhere between the minimum amount and the full amount due so that you are working towards paying off the account and getting your title back, because that is our lingo, which is get your title back with Title Max.
One more, Mr. Chairman, and that is, how many times will you allow them to, how many times can I roll it over? I don't meet my first month. I'm gonna roll it over to month number 2. How many times would you allow a person to do that? And in addition to that, what is your range of what you're gonna charge the person after you finish your underwriting?
So to address the first question, there is no set number of times that we would tell the customer that they would not have that option. We give customers the option to do whatever's best within their financial resources. However, what we're doing is we're encouraging them. We're having these conversations with the customers every time they come in, and we're explaining, if you are not going to pay more towards your principal, then you're going to continue to pay more than if you were to pay additional funds towards the principal. We want them to get their title back. And then second, the question was, how much are they going to pay? It depends on, again, there's not a standard range because we're underwriting the customer and we're underwriting the collateral. So they could, the amounts of the pawn that range from $100 to $10,000, depending on what the customer is looking for and what they are approved for on the underwriting criteria.
Thank you. 24.
Very quickly, one thing area that I am very amenable to and just curious your client's stance in, that is a provision that would require you guys to refund any excess payment that's received after you sell an item and have recuperated or recouped your expenses, whether that's attorney fees, repossession, et cetera. Is that something that the industry is willing to acknowledge that is just from a fair practices? Just gentlemen, right? If you borrowed money from me and we have an agreement and I loan you less than something's worth, and yes, it goes through a heartache to try to get my money back, but I'm able to sell the asset that I've now repossessed for more than, you've ever borrowed and covered my expenses. Just philosophically, that's something that I think is something I'm interested in. I understand some of the other arguments. And then the other thing is, I'm very curious as to why a company would, given the fact that there's a constitutional question related to an entity that before our Supreme Court, that you would immediately settle, because what happens if they go away, and where's that $10 million going to go? It says it's in a victim's fund, but if they're disregarded, are you going to get your money back? Those are just business questions that make me scratch my head as to why I would not want to at least enter into a stalemate mode until those questions are answered.
I'll kick that one over to Victoria. I think she'd be better suited for that one.
This is a question very near and dear to my heart. As a former litigator, there were significant legal theories and significant discussion amongst our organization as what we were going to do. However, it came down to, it's a business decision. This is a distraction for us. This investigation was ongoing for 2 years. It required significant resources to respond to the Bureau, to provide the data, to continue to litigate or to continue to engage with the Bureau and to litigate this issue. I will tell you, we contemplated filing an affirmative Fifth Circuit action against the Bureau. We contemplated what it would look like if the Bureau sued us. Especially we thought that there would be a stay in the proceedings. And now that we know the Supreme Court is going to take this matter, there's not going to be a decision until June of 2024. That would have required, it would have given us a stay of all of this activity for a long period of time. However, lawyers don't make the decisions for the business, and so the business wanted to put this behind us, wanted to just show that we were a good, we didn't admit the factual or legal allegations in the consent order, but we wanted to put it behind us.
29.
Thank you, Mr. Chairman, and I think Vice Chairman Wade was maybe going here. I'm having a hard time hearing the lady on, but I know a lot of all financial institutions follow default rates very closely. And I'm just curious, is that something with the rate, default rate where you have to take back, transfer the title? Is that something y'all could disclose, or is that something watched by your industry, that rate? Travis.
So, I mean, yeah, we do pay attention to default rate, and that, I mean, that is part of, our business model is looking, it's a high risk situation. I think in Georgia, our average default rate is between 25 and 35%. So, I mean, that is, part of the risk of the business.
Thank you.
Thank you. Dr. Representative Clark, excuse me.
Thank you, Mr. Chair. So I took a moment and went to the website for Title Max, and I noticed that most of the language on the website says that you all do title loans, but then if you keep scrolling in Georgia, it switches and says, but in Georgia, we do title ponds. So I'm just curious, functionally, like actually in day-to-day operations, what is the difference between doing a title loan in another state and doing a title pond in Georgia?
Victoria.
So there is a specific provision in the Georgia pawnbroker statute that we have to advertise it as a pawn. And so that's why you see the difference on the website to advertise it that way. The difference between a traditional title loan and a title pawn is that with a title pawn, after 60 days, so if your payment was due on March 1st and you didn't make that payment for 30 days, you get a 30-day redemption period where we're not seeking to collect that collateral. But then after that 30-day grace period, if you do not pay, the title of the vehicle shifts automatically to the lien holder or to us as a result of that. That is not functionality that exists in other title loan states, as well as in the pawnbroker statute. There isn't, as we've talked about, the requirement to return the surplus to the collateral because it is a pawn, and the difference between a pawn and a loan is very different. In addition, there are certain things in terms of the bankruptcy code that are impacted by a pawnbroker, the pawnbroker provisions, and the transfer of title automatically. So I would highlight those as the three main differences.
Thank you.
Okay, we have one more speaker. Brandon Cordell. Thank you, Victoria.
Mr. Chairman, if I can say, my name is John McCluskey. We came up to try to sign in, and it had
Oh.
already been taken away. And I think we decided as an industry, if I don't know how much time we could all have. But
Give
if I
me,
gave 3
give me 4
minutes.
minutes because we got a lot
Yeah,
of members
I'm
trying to
happy
get
to
out of
work within
here.
that.
Okay.
Let me introduce my name is John McCluskey. Thank you for having me. I've been for the past 17 years, Vice President, General Counsel of Select Management Resources. We're another one of the large multi-state title loan companies. But I've been an attorney in this industry for over 25 years. I'm not sure there's anybody who's been as an attorney for the industry as long as I have. Because I've represented title lenders for so long, I've personally been involved with providing input and helping draft many of the regulations that we comply with nationwide. And Select Management has been involved in efforts in legislation here in Georgia that included many of the consumer protections contained in House Bill 342. But unfortunately, in the past, opponents would not allow the bill to have a rate of interest that permitted us to stay in business, so the legislation never passed. But we have always supported reasonable regulations and will continue to do so. However, we cannot support House Bill 342 as it will not allow us to stay in business to serve our customers. Let me be very clear. The rate cap contained in this bill will directly cause all title loan offices in the state of Georgia to go out of business. How do I know this? Because I've seen this happen in other states during my career. I've seen other state legislatures, unfortunately, believe the advocates who claim that, oh, they don't want to get rid of title loans. We just want fairer, cheaper title loans. And so the legislatures believing that passed bills very similar to House Bill 342 with this unrealistic low interest rate. And what was the result in these other states? Well, they had a brand new title loan regulatory scheme with no licensees, no lenders operating under it. Please do not make the same mistake here in Georgia. This 46-page bill is really an overly worded way to shut down this industry, eliminate the jobs and benefits we provide to thousands of Georgia families, and take away a much-needed credit option for people who, frankly, need more options, not fewer. I am not aware of any state in this country where title loans are being offered to consumers at the unrealistic rate required in this bill. Not one. Although media report differently, Georgia already does have a rate cap on title loans, and it is already one of the lowest in the country. For example, looking at our neighbors, the Georgia rate stays at the same level, starts at the same level permitted as Alabama, Mississippi, Tennessee, and South Carolina. But unlike those other states, the Georgia rate then drops to half that rate after 90 days. There is no other state in this nation that has a lower interest rate than Georgia's rate after 90 days, or even close to that rate. Further, it should also be noted that the current Georgia law does not allow title lenders to charge any of the various other fees that are not included in APR, but that are charged by other lenders in Georgia for their loans, such as late fees, origination fees, charges for various insurance products, etc., which is fine. Title loan customers appreciate the straightforwardness of no extra fees being charged for their loans. But House Bill 342 not only slashes the permitted rate that title lenders can charge in Georgia by 80%, it is an 80% reduction in this bill compared to what we're allowed to charge now. But it also continues to prohibit new title loan licensees from charging the same fees already being charged by other lenders in Georgia. No title lender will be able to survive such an unfair regulatory structure. Consumers need more financial options, not fewer. This bill will eliminate a much-needed credit option for Georgians, and we urge you to not allow that to happen. And if I could say one other thing about it, it's been said that all we're doing today with this bill is bringing into compliance title lenders in the same, under the same usury limit that all other lenders in the state of Georgia operate at. That's not really accurate. Pawnbrokers are exempt from the usury limit and have been for decades. What's happening in this bill is you're calling us something else and you're taking us out of that exemption, even though we are still a title pawn for all intents and purposes. The main difference between a loan and a pawn, and Representative, I think you'd ask this, is personal liability. Pawn, as you know, taking jewelry, your lawnmower, whatever, take it to the pawnbroker, you leave it with them. You can pay back the loan or not. If you don't, the pawnbroker can't sue you, just like we can't sue our customers. If their motor blows up, the transmission fails, and they don't want to pay back the loan, they don't have to. And unlike loan states, where there's personal liability for borrowers for their mortgage or credit cards or whatever, title pawns are not allowed to sue their borrowers. That's the big difference. And we are still would be technically under this bill, have that limited no personal liability, but now you've stopped calling us a pawnbroker, so you've taken us out of the user exemption. So I think that's a more fair way to put it. Thank you for your time.
Thank you, sir. 26.
Thank you, Mr. Chairman. Let me ask a couple questions. I'm a businessman, so I look at things. If I'm in business, I'm to make money.
Yes.
I understand that. No one holds a gun to your head and tells you you have to go in and take a loan. I understand that also. But I know a good bit about this business and both sides of other businesses besides banks. With that being said, it's hard to believe, but I would love for you to send me facts, not just hearsay, that if you're a cap of 60%, that you're going to go out of business and lose money. And I would love to have facts on that. I'm not saying you're wrong. I want to see the facts or the meat. The other part, what are the fees if I come in and most people are not borrowing $300 or $400 when they come to buy or borrow a loan? They're going to borrow several thousand. I want to know the numbers of what your most common loans would be. If it's 2,000 to 10,000, I know it costs a fortune if I borrow 10,000 from you. And that's the truth. But I would like to know also, I think what I researched, your bad debts are roughly between 15 and 18%. And that's pretty high. If it's proven it's 25, I'd like to see that also.
Okay.
And I, like I said, I deal with facts. I don't deal with assumptions and pie in the sky. But with this whole equation, I still find it hard to believe you're going to go out of business with a 60% cap. And, you know, I would like to know that. I appreciate you being here. I just appreciate the opportunity to do business without people telling everybody what they have to do. But I would love to see those facts.
Representative, would you like me to try to address some of that now? Or would you like
Yes,
me
sir.
just to
No,
follow
that's
up?
fine. I'd
Okay.
love it, but then I won't back up others. Thank you.
So in terms of facts, I mean, we can get into the financials of how expensive these loans are. I mean, our typical loan's more about $700, $700,000. These are small loans. So they're not $10,000 loan, $20,000, but we still have employees, we still have a building, we still have to pay the rent, et cetera. We have to keep the lights on. So what we make on a $500, $700 loan has to keep us in business. Now, there is an element of the number of loans that you make can make up for that, and you make more income, obviously, the more loans you make. But these are small loans and they're expensive to make. And as it's always already been brought up is there's a high default rate. I mean, these are not customers with the best credit history. To answer Representative's question, we do also use Clarity, which is a subsidiary of Experian. So they are part of the one of the big three. But I think the best fact that demonstrates what I said is truthful is what other states have done. So I've been in this industry for a long time. So Oregon, Montana, Illinois, look at the states that have said, well, we want fairer, cheaper title loans. Let's make them at 36%. They created this law. Montana, for example, 2011 passed a new title loan law, capped it at 36%. 2013, they repealed it. There were no licensees. There's several examples like that. That's, to me, the best.
And I do know that too. 36%, that's a little bit different. I understand that. I followed what you just said. That is true. But at 60's a lot different than 36%. So, and I want you to continuously finish. I just noticed that, you know, you educated me a little bit. There's other industries that average loan is 350 to 750. And these people come back and what they do is they borrow money 3 to 4 times a year. And most of them pay back the money. Nobody's going to ever loan them the money, but your industry. However, I would really like to know the percentages that are higher than that, because these people have no other choice. These people come to you and they make bad choices a lot of times, but you help them on others as the industry does. But I really, again, would like you to continue, but I would love to see this facts in writing of all the other states. And I do thank you.
Happy to. Thank you.
Thanks, sir. Representative Clark, do you have another?
Yeah, thank you. And thank you for, again, clarifying the loan versus pawn. So just doing a little like back of the napkin numbers. If I borrow $700 using my title, right now I would pay back almost $1,700 on that 700. Is that how that works? 140%.
I like to, if I can just make it just as easier, a $400 loan is you know, the interest on that is going to be anywhere from say $75 to $100 for a month.
A month. Okay.
Yes.
Right. So I'm saying in the over the totality of the loan, like if I don't pay it off early.
Well, so you have the ability, and as Ms. Newman said, we're the same way. We allow the customer to make the decision. We are constantly having the conversation with the customer. Do you want to pay some extra towards principal? Do you want to, let's pay down your principal? A lot of people borrow the loans for a specific period of time that they need it. They're in between income or whatnot, and they pay it off after a month or two. Some people take a little bit longer. But one of the benefits that Georgia has is the rate reduction. So the customer comes in and whatever the loan is, let's say their payment's $100. They're used to paying $100. After 3 months of paying that $100, even if they didn't touch their principal, if they kept paying that $100, now they're paying half of that towards principal. That's a great benefit that Georgia has that other states don't have. Now, other states have a principal reduction requirement that's a little bit that works differently than that, but that in and of itself is a principal reduction element to the current Georgia law.
Right. I understand that.
Thank you. I'm sorry. Can you catch him offline? Because we had one more speaker and then we're up against a time crunch. Thank you.
Thank you very much.
Thank you very much, Mr. Chairman. I'll be very brief. We appreciate so much Chairman Bonner for bringing this legislation. My name is Taylor Hawkins with Frontline Policy Council. We are not a consumer advocacy organization, but we are an organization that seeks to protect family and Christian values in our state. And we have taken a little bit of a dive into this over the last couple of weeks and have seen the countless personal testimonies of people who have been buried under mountains of debt because of this industry. And you heard a little of what was mentioned about the fine recently, the 15,000 cases of illegal fines. And I know that was attempted to be shrouded by what was mentioned later, but just want to reinforce the fact that this is a predatory industry and would earnestly request that you support this legislation. I'll let the Chairman Bonner speak to whether or not there were good faith negotiations engaged in to address some of the concerns that were mentioned, but just want to encourage you to pass this piece of legislation. Thank you so much for your time.
Thank you. We had one more question and then we're going to complete this meeting.
Thank you, Mr. Chairman. And to the author, thank you so much for bringing this piece of legislation. I think that the overall goal is to help the consumer. And I agree with Chairman Donahue where this becomes a cycle. The borrower keeps going back because they are the only industry that will loan that person some money for the title. Can you speak to how keeping the business the way it is now will help someone's economic position? Because I really don't think it will.
You mean the industry as it stands today?
Correct.
So I don't see that at the current status of the industry in terms of the rate, in terms of the lack of regulation, I don't see where there's the proper consumer protections in place. And so we've mentioned several times during the course of this hearing the word cycle. And I think that, that cycle of debt, and it seems to me that is what this tends to encourage. And that's certainly something that I think that with more disclosure, with some more transparency and regulation, that we could break that cycle, but yet provide the consumer with a viable product and provide the industry with a way to service that customer at a rate that they can actually turn a profit.
Thank you.
Thank you. Thank you. Thank you all for attending. And Chairman Bonner, thank you. Look forward to working with you some more on this and see y'all tomorrow.
Thank you.